bringing you the latest in tax credit news, insight, and analysis. This is Tax Credit Tuesday with your host, Michael Novogradac.
Hello, I'm Michael Novogradac, and this is Tax Credit Tuesday. This is the April 28th, 2026 episode. As our audience on YouTube can see, my guest this week is my partner, Nicolo Pinoli. Nicolo works out at Novogradac's Portland, Oregon office. Nicolo, as our frequent listeners and viewers know, is an expert in many different tax incentives. Today's topic is going to be the new markets tax credit. And more specifically, we're going to talk about new market tax credit exits or unwinds, to be a bit more precise. Now, before discussing exits or unwinds, Nicolo and I are first going to review the underlying economics of the new market tax credit subsidy. I think that kind of sets the stage for some of the implications of an unwind. And then we're going to review common new market tax credit structures. And then we'll focus on the unwinds themselves. And when I say unwind and exits, I'm thinking roughly the same, where the investor is exiting, the tax credit investor is exiting, and the portions of the structure are being unwound as a consequence of the investor exiting. Now, if you want to learn more about this topic, because we are going to go over it somewhat swiftly at a high level, discussing the core components, Nicolo is going to be the instructor next month for a 2-hour webinar and it's available through the Novogradac website. The webinar is about exit strategies for new market tax credit transactions. And yes, I will include a link in today's show notes so you can register for that session. If it sounds like we have a lot to discuss, you're correct, we do. So if you're ready, let's get started. Nicolo, welcome back to Tax Credit Tuesday and happy 2026.
Thanks for having me, Mike. It's great to be back on the show.
So this is your 12th appearance on Tax Credit Tuesday. And obviously I was referencing happy 2026 because your last appearance was in December of 2025, where we talked about new markets tax credit as well. In that episode, we discussed what has been a very hot topic within the Trump administration and as a consequence within the broader new market tax credit community development community. And that is new market tax credit strategies to support for sale housing in distressed communities. I will include a link to that show at today's show notes. And I do encourage our viewers to check out that episode, particularly given the current political circumstances and desires of the current administration. Now, whether or not you caught that episode or not, and whether or not this is your first time seeing Tax Credit Tuesday, I feel like it's always good for my guests to describe the various services they do provide to Novogradac clients. So Nicolo, please describe for our audience some of the many services you provide to Novogradac clients.
Sure, Mike. And generally speaking, we're pretty much cradle to grave. So everything from the front end, helping you put your deal together and get it closed, including lots of advisory services on the front end, as well as new markets reports for QALICB status, pre-incurred costs, and of course, a nice little forecast compilation engagement to ongoing services we provide related to ongoing compliance, audits and tax returns, as well as when you get to the end of your transaction and you're ready to unwind. We do a lot of work with clients, helping them to unwind their transaction and make sure that they capture their desired economic benefits and also record all of the sweet activity associated with putting your deal together and putting it to bed.
Great. Thank you, Nicolo. And that's all on the new market tax credit side. Maybe just mention a handful of other tax incentives that you work with pretty extensively, but you don't need to go into the services.
Sure, Mike. As you know, I also do quite a bit of work in the affordable housing space, as well as the opportunity zone and historic rehabilitation tax credit, and even do a little bit of work in the renewable energy space as well.
Great. Thank you for that. Now let's jump into new markets tax credit. And as I mentioned in the intro, I wanted to start with an overview of the basics of the new market tax credit, because it is a unique credit in many ways, in that it's a credit for making an investment in a community development entity or a CDE. You make the investment in the CDE, and the entity making the investment is entitled to a tax credit, and the credit totals 39% over 7 years. So basically, if you put $100 into a CDE, you get $39 in tax credits over 7 years. And then the CDE, or community development entity, is obligated to make loan or equity investments in qualifying businesses in distressed communities. So that's the general overview of how the CDE is the central point where an investor invests in the CDE, and then the CDE makes investments in businesses. Now, Nicolo, I wanted you to explain to the audience the implications of this sort of tax credit, where you get a credit on the amount invested that's less than the total amount invested.
Sure. There's some exciting implications, and really compare and contrast with other incentives, say
Yes.
the low-income housing tax credit, historic rehab, or even renewable energy credits. Those are all based on the cost of producing the desired asset, either affordable housing or renewable energy facility, or even a historic building. Here in new markets, the credit is triggered based on the investment itself. And you bring up a great point that the credit is 39%. So a $100 investment yields $39 in credits. And that tends to drive an exciting structure in order to monetize the credit, to syndicate the credit, you really end up needing to leverage non-tax credit dollars to bring them into the structure and help to facilitate that investment. If my investor is receiving $39 in tax credits, they're going to invest less due to the credit being a taxable credit and due to the time value of money, since the credits are claimed over 6 years and a day or 7 years, we might say sometimes, because it's a 7-year compliance period. So just for example, if my investor were investing 30%, that means the other 70% needs to come from an economic investor who's providing a leveraged loan into the structure. And that has the benefit then of really bifurcating our two risk profiles. You have an economic investor who cares very much about the economics of the project, its ongoing ability to remain a going concern and to eventually repay that debt. Whereas our tax credit investor, its risk is really tied to the tax credits itself on an ongoing basis through the entire compliance period, and doesn't face economic risk in the same way that that economic investor does. So as a result, you end up mixing those $2 at an investment fund level, and then using those dollars to make a qualified equity investment in our sub-CDE that then triggers those tax credits.
Now, not to go too much down memory lane, but as you point out, the current common structure is for the CDE to receive an investment from a partnership. And that partnership has both debt and equity. The debt for the economic piece of the investment the city is going to make, and an equity investment for the tax credit piece. Now, I will say, as you know, that back in the day, one of the questions was, can you just have a partnership that invests in the CDE that has an investor who is going to invest cash in the partnership, and they're the economic investor, and a separate investor invests for the tax credit piece? However, we have not been able to get the Internal Revenue Service to issue guidance as to how partnerships allocate the new market tax credit. We think we made a good case as to what that methodology should be, but since we do not have guidance as to how a partnership allocates credits, the investment fund that's investing in this community development entity essentially has to have a 99.9% tax credit investor and a loan coming in, so that you don't have to answer the allocation question, which is more than most in the audience needed to know, but I couldn't stop myself. So you end up with this upper tier fund with debt and tax credit equity that flows into the CDE, the community development entity. And then that CDE in turn needs to make equity investments or loans. They technically cannot make grants, or said differently, grants don't qualify as a use of funds for the overall asset test of the CDE. And as a consequence, you don't generally see the CDE making grants. They're making either equity investments or loans. And if you could now describe what some of the common structures are for CDEs in terms of the investments they make in qualifying businesses?
Yeah, well, certainly you're right that grants are not a QLICI, a qualified low-income community investment. Rather, the statute tells us there are several different flavors of activities that qualify. And really the two most prominent and likely options are either debt or equity investments in a QALICB. My experience is that equity investments are rare, and there's a whole host of technical reasons why that plays out. But as a practical matter, certainly if you're looking at a percentage of deals getting done these days, it's in the high 90s percentage-wise that are done with QLICs or debt loans from the sub-CDE down to our QALICB. And
I'll just
often,
interrupt you for a second.
yeah,
As you know, but just as a shout out to all of our historic tax credit clients, the historic tax credit use with numeric tax credits is a notable exception to this general rule. And there has been a large number of historic tax credit transactions used with the numeric tax credit. But that's a unique case that is a high valued case. But I totally agree with you. Generally, we'll see debt. And just for our audience, one of the reasons why you generally will see debt as opposed to equity is because of some of the rules around tax credit recapture, which we're not going to go into here, but there are some changes the IRS could make to the regulations that would create as great a burden on equity investments that exist now. And I'll just leave it out there. Email Nicolo or I if you want more details on that.
you know they do, Mike.
But sorry for interrupting. I had to give a shout out for historic.
No worries. We definitely have lots of derivations on our traditional model. Often when you think about those loans that our sub-CDE is making down to the QALICB, they get split either very quite literally or conceptually into two pieces, an A piece and a B piece, that really tend to mirror what's happening up at the fund level, where at the fund level, we have two sources of capital. You've got the leverage loan or the debt or economic piece. And usually that passes through down to an A loan in terms of sizing, but also in terms of tracing through rates and terms. And correspondingly, you'll have the B piece, which really is the net tax credit equity that comes through. It's made in the form of a loan from the sub-CDE down to the QALICB. And in this scenario, most deals that get done these days, my experience is both of those loans are papered as longer term loans. While they're often interest only for 7 years, beyond the 7-year compliance period, usually they then begin to amortize starting in year 8 and will amortize often evenly over the remaining terms, such that by the end of year 30, if the transaction were to run for that long, the loans would be fully amortized by the end of year 30. And that's, I think, a pretty typical execution these days, fairly traditional NMTC structure that we see in terms of the source of capital coming in and how that capital then drops down to our QALICB and the rates and terms associated with those loans.
So what you've described as the classic structure is the CDE is making two loans. And once again, the classic structure has various, it could be multiple loan A's and multiple loan B's and the like. But for purpose of this discussion, there's a single loan A, a single loan B, with loan A having certain terms and loan B having certain terms. And you mentioned in your answer to the prior question about the A loan matching the investment fund, if you could build that out a little bit more in terms of how the loans the CDE is making, what relationship they have to what the investment fund that's investing in the CDE, what their financial structure is.
Sure. And typically it's a bit of a pass through, maybe with some adjustment for any fees and expenses that are being paid at the sub-CDE level. As a result, you think about it, just to give some very rough examples, if my money at the investment fund level is coming in, say at 6%, because it's only 70% of my capital is coming in at 6%, the other 30% of my capital is really zero cost of capital, the tax credit equity piece. That allows me to blend down my interest rate on my QLICI loans where leverage might be coming in at 6, but I can often blend down my QLICIs to say 3, 3.5, or 4%, depending on exactly how many other fees and expenses are then being paid at the subsidy and investment fund level. And as a result, that's one very powerful tool to buy down the interest rate related to the QLICI loans. And I know you look at this scenario and say, when does the subsidy sink and how do we go about really spending that subsidy in terms of how it's delivered to our QALICB? And certainly there are a couple of common approaches. One is for the subsidy to sink at the end. In my experience these days, that's the most common scenario, where essentially the residual value is delivered to the QALICB through some mechanisms we'll discuss later at the end of the compliance period. But in theory, and certainly we've done some deals, especially earlier on in the program, where the subsidy really sinks over time, such that we have a scenario where more subsidies being delivered earlier on during the 7-year compliance period by further buying down the interest rate on those QLICI loans.
Right. And then there's also the concept of an evergreen fund, where the loan that the city is making is below market. And then at the end, the tax credit equity piece, if you will, is repaid and it's relent out to qualifying businesses. So I think of it as 3 options. One, where the interest rate's bought down a little, or it's bought down a lot in terms of percentage, in terms of interest rates and benefits, bought down a lot, so that some of that subsidy is sinking over the 7-year period. And then the residual fully sinks. The goal is to fully sink the subsidy at the end of 7 years. And then there's the approach where the subsidy sinks over that full 7-year period. So there's really, quote, no subsidy left at the end. And then the last is where the subsidy is there every year for 7 years and then recycle into additional qualified, so kind of like an evergreen fund. With that, anything else you want to say on that, or should we jump into different perspectives, the businesses and investors?
I think perspectives would be great to get into next.
So please, the investor and the qualified business are obviously together. They end up in this business structure over the 7-year period, where the investor, and when I say the investor, a tax credit investor in the investment fund, the tax credit investor is saying, I've given you my portion of the capital. Portion of the capital's come in through this loan. At the investment fund level, you've gotten 100% of the capital at this discounted rate. Over this 7-year period, you've now built your business, started your business, you're running your business for the 7 years. Over that 7-year period, the investor getting their credits, they're happy. The lender of the investment funds getting the interest payments flowing through the CDE, they're happy. Once you get through the end of year 7, the credits have all burned off. Now, at that point in time, share with our audience generally what the tax credit investor would like to do, and generally speaking, what the qualified business wants to do with respect to the structure that's put in place.
Sure. Typically, once we get out past the end of the compliance period, I think both parties are really looking at this structure and saying, this has been fun. We've really enjoyed having this partnership for the last 7 years and getting lots done together and delivering lots of great community outcomes for this community. But now that the credits have all been earned, and that's certainly from the tax credit investors' perspective, they've received the bulk of their expected returns. From their perspective, they're ready to move on. And the tax credit investor at that point is usually probably looking for an escape hatch, a way to unwind the transaction and exit from their ownership in the structure. And I think similarly for many QALICBs, they've received the capital, they've used the capital, they've delivered on a lot of the community outcomes and benefits that they were really expecting to deliver for the community, and certainly to allow the investor to be able to take credit for having participated in all of these great outcomes. And from the QALICB's perspective, they're probably ready to move on too, because as great as the structure has been, there's probably not much of an ongoing benefit to keeping that structure around. And in many cases, they're looking to simplify their lives and simplify their structure and be able to focus on their day job of getting back to the business itself, rather than having to manage all the additional compliance and reporting that comes with a new markets deal.
And I do want to emphasize for the audience that one of the purposes of having this 7-year period is investors getting the credits as long as all the rules around new market tax credits are complied with. And it's a way of paying for performance. It's a way of the investor putting in their capital up front and getting a credit every year over 7 years, so long as the CDE is complying with all the rules contained in Section 45 Cap D. Both the timing, in terms you have to wait for the credits, everything continue to perform in accordance with the rules. And then there's also recapture, 100% recapture. So there is this monitoring that happens and makes the new market tax credit a pay for performance tax credit, which I'm a big fan of. I think it's one of the beauties of tax credits is there is this pay for performance aspect. But once you get through the 7 years, there's been this performance, the recapture burns off, there's no credits left. And then it natural sense, as with other credits at the end of these sort of terms of pay for performance, that there's a restructuring. And then Nicolo, if you could share with the audience the use of options as a way to address the unwinding and creating optionality, pardon the pun, for the investor and the qualified business to facilitate unwind or an exit should either one desire to at that time.
Sure. And I think it's important to note that these really are options, meaning in theory, they don't have to be exercised. The parties on either side can choose to exercise it if they want, or can decline to exercise that option. There's really no compulsion that forces them to do it. It's really an opportunity for them to decide whether they like this option or they prefer to proceed without it and merely continue to run through the remaining papered and structured transaction all the way through to the end of potentially 30 years out. Often in new markets land, we get a little casual as we talk about these options. Often we kind of lump them together and even use just a single word or what seems like a single word because we fuse them together into the put call. And they're really two separate things.
Put is not a call, a call is not a put.
Yes, they are two very different things. As the song says, you got to keep them separated. And so we'll endeavor to do that here today. And keep in mind that let's pick up the put just a little bit and talk about how that works. The put is an option that's held typically by the tax credit investor. And it runs for a window of time, often after the end of the compliance period. It runs for a period of 90 to maybe 180 days after that conclusion of the compliance period. And it's the right, but not the obligation held by the tax credit investor to sell their ownership interest in that investment fund to a pre-specified new owner of the fund. And part of the fund with this put is strike price associated with this option is typically a very nominal price. And these days I see it usually either $1,000 or in some cases, maybe $10,000, plus of course, attorney's fees associated with the exciting documentation of the unwind, which usually are not too substantial. And I think there's some exciting tax implications around why we structure these puts for a nominal price, mostly to help reinforce the notion that we want, which is that our tax credit investor is in fact the owner of the investment fund and should be respected as the owner of the investment fund. And if out of the kindness of their heart, for their own inscrutable reasons, they decide to sell that asset after 7 years without any compulsion or pressure from an outside party, then their ownership shouldn't be tainted during the 7-year compliance period. They should be respected as that owner and therefore be able to claim all of those sweet tax credits during the full 7-year compliance period. You take the flip side and say, well, what about the call and how does that differ from the put option? The call option typically also has a window that starts when the put option is completed. If the put is not exercised, the call in theory would then become available. It's an option held usually by an affiliate of the QALICB leverage lender or other affiliate. And It is the right to force the investor to sell their ownership interest in the investment fund. Now, there's a key difference between the put and the call, and the key difference is the strike price. Whereas the strike price under the put option is a nominal price, under the call option, it's critical that that strike price be at fair market value. And there's a whole host of important tax issues that come into play, but the critical one, again, is making sure that our tax credit investor is respected as the owner of the fund by ensuring that this option is at fair market value. That leaves some real question as to whether the option will be exercised, and certainly leaves plenty of question around whether the tax credit investor, and certainly there's every reason to believe that they could continue to be the owner of the investment fund all the way through to the end of the documented transaction. And as a result, having this call option doesn't interfere with the delivery of the tax credits, which makes everyone happy in terms of giving optionality for the investor to exit at the end of year 7 and giving optionality to our QALICB to also attempt to force an exit at the end of year 7.
So I just want to did a great job explaining it all, and I'll just emphasize what you said several times just to make it super clear. The put has to be below market value, and normally it's nominal. And in that way, there's no assurance or presumption that it would ever be exercised. And obviously, if it was above fair market value, then there'd be a presumption up front that it would ultimately be exercised as a consequence. Whether or not they're really an equity investor, there's all sorts of other issues that get involved. So that's on the put side. And once again, as Nicolo mentioned, the tax credit investor holds the put there. And then on the call side, it can't be below fair market value, because if it was below fair market value, you could basically buy the investor's interest below fair market value. Then of course the IRS would look at that and say, well, of course you're going to exercise it. So then you get into the issue of the equity investor. So that the call option can't be below fair market value. So that's all easy to say. Now let's think about the implications of the investor exit. And
Sure.
The investor exit doesn't necessarily have to be pursuant to the put or the investor exit pursuant to a call. It's more that the investor is exiting. And what are the implications of the investor exiting? And there are implications, obviously, to the investor. We'll talk about that. And there's implications to the qualified business. And there's implications to the CDE, but I'm not sure how much we want to spend time on that. But maybe we'll start with the investor. Nicolo, describe the implications to the investor of the transfer of selling their interest in the investment fund that invested in the community development entity.
Sure. You're absolutely right, Mike, that the put and the call exists mostly as an easy way to help facilitate the exit when we get to the end of year 7. It's pre-baked, pre-negotiated, all ready to go. And it makes it that much easier to facilitate the exit, which is why we do it rather than just waiting to the end of year 7 and negotiating something. We could do that. We can still do that even with the puts and calls in place. So that's always an option. Life gives you lots of alternatives, and that's certainly one that's on the table. And I've seen it happen before.
Yeah, me as well.
But from an investor perspective, typically when an investor exits, they will have a bit of taxable gain associated with their investment. And that's part of the reason why our tax credits sell for a discount. There's 2 key components that drive that. One is the time value of money, because the credits are delivered over 7 years, but also separately because the credit itself is taxable credit, meaning there is a basis reduction that accrues to the investor due to their claiming of the credits. As a result, our investor typically will end up with a gain on the sale. If you think about it, if our investor invests 30 cents and receives 39 cents in credits, our investor has a 9-cent gain on that sale, ignoring any other sort of noise related to interim income and losses and amortization and all that sort of fun stuff. You have this 9-cent gain associated with the exit and the sale of that ownership interest that accrues to our tax credit investor.
Great. Thank you for that. And you had mentioned something about some of the possible misinformation around the amount of the gain.
Well, I think a lot of the fun is on the QALICB side.
Okay.
So if we switch gears and think about our QALICB, and really, I start by thinking about, is it a nonprofit or is it a for-profit? I think on the nonprofit side, the analysis is usually often very quick and easy, which is this part of my nonprofit mission? Usually it is. And if so, it's probably then not going to be unrelated business taxable income. Obviously, you want to consult with your tax advisor to confirm all those assumptions I just made rather glibly. But assuming those assumptions are accurate, and it's important to confirm them, then you're probably not looking at a tax implication on a nonprofit. On the for-profit side, on the other hand, you probably do have taxable income due to the cancellation of debt rules. And you said,
unpack that for a second there, because what we're talking about here is in this structure that you're talking about now, the ownership of the equivalent entity is still the investment fund. At the investment fund level, the tax credit investor has left, and the CDE has both this A note and the B note. And then the A note was designed to roughly mirror the investment fund loan. So that A note basically matches the investment fund note so they can move forward. And it's the B note that ends up being forgiven. Is that what you're implicit in what you're discussing here?
Yes, I was just about to get to the exciting details around the math, but you're absolutely right. The B piece really is the amount that's on the table and that economically is available to be transferred to the new owner of the investment funds, which if it's a QALICB affiliate, essentially means that our QALICB affiliate is buying its own debt at a discount. Now, your initial reaction is to say, well, I didn't really buy my debt. I bought the fund, except for the fund really just owns the sub-CDE. Often it'll own 99.99% of the sub-CDE, and the only assets of the sub-CDE are the QLICI loans. And I go on to point out that it's very common after put is exercised, assuming it is exercised, that then the structure will be further collapsed with those loans being distributed up to the fund and often even being canceled or assigned in satisfaction of, say, the leverage loan or other ownership interests. And so even if you wanted to argue that I haven't bought my own debt, often you end up in a position where you have bought your own debt once we proceed with the exit of the transaction. But I think you mentioned, Mike, this notion of the dollar amount of the cancellation of debt income. And I will say it's not uncommon when I work through an unwind with a client where they will have an initial moment of panic and they will think the full amount of my debt here is potentially subject to cancellation of debt income. And Mike's shaking his head and saying, wow, because that would be something to get excited about. That amount of income would be devastating. I think the thing that we often struggle to realize, or at least initially people, when they have that initial freak out, they forget about when you buy the investment fund, when you take over the tax credit investor's position, you're not just buying the QLICIs free and unencumbered, you're buying them subject to that leverage loan. You become the new obligor under the leverage loan. And so while you've just received this great basket of QLICIs, and you might have only paid $1,000 plus attorney's fees, you've also had to become the new obligor under the leverage loan. Therefore, your COD, your cancellation of debt income, is the dollar amount of the QLICIs less the dollar amount of the leverage loan, less the dollar amount of the price paid to acquire the investment fund. As a consequence, the dollar amount of the cancellation of debt often is right around the dollar amount of the B loan.
Thank you for that. So now we're looking at this unwind. The investor leaves. If they choose to unwind versus continue, the investor leaving creates taxable income for the investor because of the basis adjustment, as you mentioned, being more than the equity investment that they invested. So that by definition creates gain. And then the qualified business also now has income because the B note is in substance sort of being forgiven. And that's roughly the amount, as you were pointing out, the amount of the cancellation of debt and his income that would be recognized. You also pointed out that if it's a for-profit entity, that's the qualified business, and it's part of their mission, well, they don't have to worry about unrelated business taxable income. Then they don't need to be worried about the tax implications of that. If it's a
nonprofit, yes.
But then, did I say, yeah, if it's a not-for-profit, nonprofit, thank you for clarifying that. It's very important. If it is a not-for-profit, but if it's a for-profit, then it does have, as a general matter, taxable income. So explain some of the implications of that to a for-profit qualified business.
Sure. And certainly as we work through the unwind process, once we've thought through and worked through the business issues, then the next question is, how about the tax side? And if I have this cancellation of debt, what can I do to attempt to manage that in some fashion? And obviously we're not talking about tax avoidance. We're talking about tax planning. That's a very important distinction. And really, there are a number of strategies. Maybe let's unpack a couple of them just to give our audience a flavor for some of the more common strategies that I see used here. And obviously, if you think about, if I'm talking about having potentially a tax of, call it on a $10 million transaction, it's probably $2.5 million in potential cancellation of debt income. That's meaningful, especially if that income's flowing up to individuals where it's taxable both for federal and for state purposes. You could end up with a tax rate, especially if you layer in some local taxes, well into 40% and even approaching 50%. In some scenarios, you could be looking at a tax bill of $1 million, maybe even $1 million and change, to where that's not just the kind of money you have laying around. Maybe you'd like to find a way to reduce that obligation. Two common ways. One way is to say, maybe we don't have a related party that buys the fund when the investor puts, assuming they put. Instead, we have an unrelated party that comes in and is the new owner of the fund. Now, that does create some business issues because now they have the right to that B piece, the right to the residual. And so therefore, our QALICB will end up having to repay that B piece and repay it to the new owner of the fund. But certainly we've managed to, at least for now, avoid having that taxable income. Our new owner of the fund will end up probably recognizing taxable income as those payments are received. So we've shifted it to them, and we've shifted the timing to be as we repay the debt rather than all up front when we exit. That's one interesting option. I've seen deals done in that fashion, and it's certainly an attractive option, assuming you have someone that you like to come into that position and be the new owner of the investment fund. I'd say another option that's on the table is the qualified real property business indebtedness exception. And since we don't have enough acronyms in new markets, I'm trying to get everyone to get behind the idea of adding Corp B to our lexicon as qualified real property business indebtedness. And the idea is that if the debt is secured by real estate and was used to facilitate the acquisition or construction or rehabilitation of real estate, there's an exception to the general rule that the QALICB would have cancellation of debt income. There are some limitations on this exception. Among other things, you can't have any corporate ownership in your QALICB. To the extent that you do, then your ability to use the exception is limited by that percentage of ownership. Additionally, the property actually has to be worth less than the dollar amount of the debt. So if I have $10 million in QLICIs, I can only use this exception to the extent that my property is worth less than $10 million. That's an important distinction because sometimes people think, well, less than the A note, less than the B note, it's less than the total combined debt. And certainly if I have other third-party debt, outside debt, that all gets added into the mix when looking at this calculation. I will say if I use this exception, it's not all sunshine and roses because you do end up, while you don't have to recognize the cancellation of debt income, you do end up losing future depreciation deductions. So there's this offset, if you will, but most parties that I know be happy to reduce their taxable income today if it means that they just end up having to give up future deductions over the remaining depreciable life of that asset.
Great. Thank you for sharing that. I know we got into the weeds a bit, or Nicolo did on that. And I've been getting into the weeds as well. So
we're having fun.
We're having a good time. And those of you more experienced with new market tax credit structures certainly can follow along a lot more readily. Others of you maybe are getting playback and listening to it a few more times, but there's a whole host of other aspects of all of this that we could have covered, but it does demonstrate the importance of beginning with the end in mind. And I thought your point about qualified real property indebtedness and the need for the debt to be secured by the real estate just really demonstrated the reasons why at the very beginning, you want to be thinking about what the various options are at the end of year 7 and what your plan is, and then what your options are, because 7 years from now, you don't know where you're going to be in a whole variety of areas. So you want to have, multiple options when you get to year 7. With all that said, Nicolo, we mentioned that you have this 2-hour webinar coming up that will go into all these sort of issues in a lot more detail with graphics and charts and things of that nature. Feel free to make a bigger plug for that webinar. But in addition to that, also other resources you think our audience should be aware of as they're thinking about beginning with the end in mind for new market tax credits.
Yeah, the webinar is going to be good fun, and certainly invite all of you to come join me for that. In addition, we have an upcoming conference in June in DC for the new markets tax credit, and there'll be lots of discussion there. And to the extent that you have questions about exits, I'll be there, and certainly excited to chat with anyone who comes. And we've got our new markets tax credit handbook and lots of resources on our website. So just about anywhere you could possibly want to go, we've got you covered, and love to see you at the conference coming up in June.
Great. Thank you for that, Nicolo. And thanks for joining me in the podcast. Please do stick around for the off mic section. Before we get to that, I encourage all of our listeners to subscribe to Tax Credit Tuesday, whatever platforms you get your podcasts. And if by chance we're not on a platform you get your podcast, let us know. We'll be there soon. Also, please take a moment to like and comment on the video, or on the episode, I should say. By your liking and commenting, it helps raise our visibility and makes it all that more rewarding to continue to produce these weekly Tax Credit Tuesdays. I also encourage you to share episodes of Tax Credit Tuesday with your colleagues. And lastly, if you have questions you want us to cover in an upcoming episode, please take a moment to send an email to contact@novoco.com. And with that, we have reached our off mic section, where my guest gets to give a shout out to others working in the tax credit and tax incentive communities to highlight someone worthy of recognition. And it's been a fun part of Tax Credit Tuesday over many years now. And there's so many people worthy of recognition, and it's nice to have an opportunity to do that on the podcast. One thing there's not enough of in this world is earned recognition. So Nicolo, who would you like to shout out?
Sure, I'll give a shout out to my good friend and colleague of many years at the National Community Investment Fund. The CEO over there is Saurabh Narain. And you may remember, Mike, you, I, and Saurabh, we all worked on a new markets transaction about 20 years ago that was my very first NMTC transaction. And I've been working with Saurabh and NCIF ever since. So it's been my great pleasure to be able to have lots of great adventures with NCIF and with Saurabh, and certainly want to shout out to Saurabh and all the great work he's doing over at NCIF.
Great. Thank you for that, Nicolo. Let me echo that shout out. Narain is really a thought leader in the community development and lending space. So it's been great to work with Saurabh Narain over the years, and look forward to continuing to work together over many years and all the leadership that he provides. So great shout out, Nicolo. Thank you for being on the podcast today. And to our audience, I'm Michael Novogradac. Thanks for listening.
This weekly podcast has been brought to you by Novogradac. Archived podcasts are available online at www.novoco.com/podcast or by subscribing to the Tax Credit Tuesday podcast in iTunes, Spotify, YouTube, and Radio Public. You can find related links referenced in this podcast on our website at www.novoco.com/podcast. Novogradac is a national certified public accounting and consulting firm with offices nationwide. Learn more about our professional services at www.novoco.com.